There is a lot of confusion surrounding SMC trading. Is it too complicated for beginners? Is it really a powerful strategy that can make a lot of profits? Well, today we're gonna go over the major SMC concepts without relying on overcomplicating strategies, so everyone, even beginners, can understand how to properly learn SMC trading. First things first, you need to understand what is SMC trading. So SMC stands for Smart Money Concepts. So what does it mean? It means that it's a strategy that focuses on trying to trade like the big institutions and the big banks, because we already know that we are not the people that are moving the markets. The people who are moving the markets are banks and institutions. And basically there is a theory that how they trade is by leaving orders behind that are waiting to get filled, and we are gonna identify those zones where there is a lot of orders to enter in positions at that specific point. So SMC trading, you might heard a lot about it. A lot of people call as well it ICT trading. Basically SMC, ICT, it's the same pretty much thing, and in SMC trading you will as well see that there is a lot of different names for the exact same concepts. I'm gonna show you the names that I use, then I'm gonna as well say you the synonyms that some other people use, but basically it's all the same concepts. It's just depending on how everyone is using them and how they're combining them together. So first things first, you need to understand that on SMC we have basically 5 major concepts, not more, 5. And those concepts are, first of all, you have the POIs, so it's the point of interest. Some people call them as well OB, that is order blocks. So POIs, order blocks, are pretty much the same thing. Then afterwards, those things are called that way because they're points in the chart that are containing a lot of orders. So what does it mean? So for example, right here, this is a valid POI. So we will see how to identify a valid POI later on. But basically what it means is that at this specific zone where price will come back into it, there's gonna be a strong chance that this zone reacts. So this is, first of all, we have POIs slash order blocks. Afterwards, we have the Fibonacci retracements. So the Fib, that is Fibonacci retracement, okay, and this will as well be useful to identify your discount and premium zones, so you can buy the cheapest price possible and sell at the highest price possible. Of course, we're gonna go over this concept as well in this video. Then you will have your trading ranges and your break of structures, so BOSS, so break of structures. So this will allow you to identify your structure, so know if you're bullish, so if you are in an uptrend, or bearish, so if you are in a downtrend. And this will as well be useful for us to identify our trading ranges, so the points where price is trading at the moment. Then, like I said, we have 5 of them. So after the break of structures, we have the liquidity, so liquidity or inducement. So liquidity and inducement, so I just write the synonym, so liquidity and inducement. Basically the liquidity or inducement is where there is a lot of resting orders that are ready and waiting to get swept. Okay, so we will go as well over this concept right here, and that's pretty much it. So I said there is 5 of them, right? So we named 4, right? We named break of structures, the POIs, the inducement slash liquidity, and we named as well the Fibonacci, right? And the last concept that a lot of people might have already heard of is the fair value gaps or the imbalances. So basically fair value gap or imbalances as well, it's both synonyms, but it's pretty mean the same thing. So it's the last concept that is englobing SMC trading. So if you know how to identify one single of each concepts individually, then you can use them to create a mechanical strategy. So in this video, I'm going to show you how to identify every single one of those concepts at first, and then we're going to put them all together to create a full-on SMC strategy. So first things first, let's go over the major concept, that is the break of structures. When you identify a break of structure, you need to understand where is your trading range. So a break of structure happens when a high or a low is broken. So as you can see right here, we have right here this high, so we have this high, we have this low. Then we have this high, this low, this high, this low. So this is your highs and your lows, right? Then every single time that a high or low is broken, we have a break of structure. So right here, this high got broken and we created a new high, right? So we have a break of structure. Same thing, right here, break of structure. Then same thing to the opposite direction. If the low now is broken, we have a break of structure. Some people call this a change of character, but for my strategy, I want to simplify it as much as possible. So for me, I don't differentiate them both. For me, both of them are break of structures. So break of structure to the downside. And every single time that we have a break of structure, we have as well a trading range that is created. So a trading range is between a high and a low. So if I go back and right here, the actual trading range would be from this low to this high. Why? Because this is the last high that got broken and this is the low connected to this high. So this is your trading range from this low to the new high. When we broke structure to the downside, the new low will change, right? Now this is the current low. So the new low will change right here. The high, however, for now stays the same. If we have another break to the downside, now same thing. Now it will change both of them, the high and the low. Why? It's because as you can see right here, now we have a new high connected to the low that just got broken. So now this high moves here and the new low will be the new lowest point exactly right here. As well, bam, that's it. Break of structures and trading ranges. Now, if you go on a real chart and you go, for example, on a real chart right here, let's try to densify them on a real chart. So first things first, when you're looking at a real chart, it's not lines, right? It's not a linear chart. So it might be a little bit more complicated, but it's the same concept. So first things first, you're going to identify what is your structure. If for you, a candlestick chart, it's too complicated, you can as well just go right here and modify to linear chart. And this is exactly what we did. So we see right here, break to the downside, break to the downside, break to the downside. You see, it's exactly what we saw on the example I sent before. Of course, there's more price action, but it's pretty much the same thing, you see. So bam, bam, bam. And if I change it to candlestick chart, you see, we straight away identified our break of structures. That's it. And as you might have noticed as well, here we have candlestick body closures and we have wicks. A break of structure is valid from a valid body closure to another body closure. Wicks are not included. Some people identify it from wicks to a body closure, but for my strategy, it's from a body closure to another body closure. So as you can see right here, price was here and we broke structure to the downside and we closed with this candlestick. As you can see, we closed below the previous candlestick. So this is a valid break of structure, as you can see. Same thing, we have this low and they extend the line and this next candle closed below this one. So it's a valid break of structure. Same thing right here, we extend the line, closed below, it's a valid break of structure. And as you can see as well, we can identify at the same time our trading ranges and our highs and lows. So at that point we have this high, this low, then now we have this high, this low, now we have this high and this new low. And then if, for example, I go back in time, exactly right here, now if I want to have another break of structure, I need to rather break either this high or I need to rather break this low right here. So this is technically our range that we just identified. So to have a break of structure, we need to get outside of the range, like right here, bam. We broke structure to the downside again, as you can see. So now same thing, you have your new high and your new low. So as you can see, this is your first step for your strategy. After you identified your break of structures, now let's go over the Fibonacci retracement. So the Fibonacci retracement is situated right here on the left. If you go here, Fib retracement, and this is a little tool that will look like this. Yours might have more little things selected. I don't know exactly which one are selected by in the base version, but the ones that you will need is only 3 values. It's the 0.5, the 0, and the 1, exactly right here. Now, as you can see, we have these 3 lines that are appearing at the chart. If you click on the Fibonacci and you click it from here to here, we have the 1, the 0.5, and the 0. Now you need to understand how the Fibonacci retracement is working. First of all, we need to understand which one of the zones is which. So as you can see right here, we have this first zone that is above the 0.5, and we have the zone below the 0.5. Right? So first things first, the zone below the 0.5 right here, it's called the discount area. Why? It's because it's where price is cheap. So as you can see right here on the right here, we have values, right? And as you can see, more I move to the downside, the less high the value is. So imagine this is dollars. So right here you see $1.60, 16 cents right here is cheaper than $1.18, right? So of course this point is cheaper than this point. So as you can see, this whole area is cheaper than the area on top, right? So when you would like to buy something, you would like price to go back into a cheap zone, so in the cheap area, so in discount, before you want to buy. If you want to sell, it's the opposite. So above the 0.5, it's called the premium area. So it's expensive. So this means, as you can see right here, $1.20, it's more expensive than $1.16, as you can see. So when you would like to sell, you would like to sell at the best price possible, right? So if you want to sell, for example, a pair of shoes, it's better for you to sell it right here than right here, right? Because here you will sell it at a better price. So when, for example, same thing, you want to sell, you would like price to go back to this area to sell it at a better price. Now, how to use this Fibonacci retracement in a real chart? You will actually just measure the price. So as you can see, we will have our trading range, right? So as you can see right here, this was our previous trading range. So how to set up the Fibonacci? It's quite easy. You go from the highest point of the previous range or the current range. So for example, right here, this is the highest point. In this case, wicks are included, and you're gonna drag it until the lowest point. So as you can see right here, this wick. So this is your Fibonacci retracement from the highest point to the lowest point of your current trading range. And this means that if I want to sell, for example, as we are in a bearish trend, so we are basically bearish, so we're in a downtrend, I would like to look for some sells. So when I want to sell, I would like to sell in this area right here, so above the 0.5 to be in premium, because if I sell below the 0.5, I'm not gonna have a good entry. And most of the time, price will like to go back in a more expensive area before pushing down. So I'm not going to be looking for sells here, but yes, I'm going to be looking for sells on top right here. So let's see what happens. So as you can see right here, price pushed up. So right here with some confluences, I can already look for some sells. And then, for example, imagine I have an entry right here. Then I will be able to target the low right here. And as you can see, I got a way better entry if I sold right here than I would have been if I sold right here. You see, my entry is way better on top right here. My risk-reward ratio is way better there than here. That's why we do have the Fibonacci retracement. Okay, so now as we talked about the Fibonacci retracement, now let's have a look at POIs or order blocks. But before talking about POIs and order blocks, we need to talk about fair value gaps or imbalances. So how to identify, first of all, a fair value gap? The concept of a fair value gap is to find an empty space on a chart between 3 consecutive candles. So for example, if I go back in time exactly right here, first of all, to identify a valid fair value gap, you need to identify 3 consecutive candles. The color of the candles doesn't matter. So first of all, we have, for example, candle number 1, candle number 2, and here we have the candle number 3. So we got our 3 candlestick identified. Then you will look for an empty space on the candle number 2. So between the candle number 1 and the candle number 3, on the candle number 2, you need to be looking if there is an empty space. What do I mean by empty space? Is that there is a space right here where there is no price action. So as you can see right here, between this wick and this wick, if I place my box, you see that we don't have any wicks. If I throw, for example, a ball, right? I throw the ball. Technically right here, there's no walls. The ball can pass through it, right? There's nothing stopping the ball. Instead, if for example we had something like this, so imagine we have something like this, now do you see we have walls, right? So there's no longer any fair value gap, because if I take this wick right here and this wick right here, now there is walls, you see? So if I want to throw my ball, it's gonna rebound off the wall, you see, boom, boom, boom. So there's no fair value gap. Of course, the size of the fair value gap can depend, but it doesn't really matter. So for example, right here, you see, this is a fair value gap as we don't have walls, so something can pass here. Here, same thing, now it's a bigger fair value gap, can pass here, right? Now, if I take, for example, let's take other consecutive candles. So let's, for example, take... okay, so let's take, for example, these 3 candles. So let me go back a little bit more in time right here. Let's say right here. Let's take this as a candle number 1, candle number 2, candle number 3. So if I go on the candle number 2 and I go from this wick to this wick, you'll see that we basically don't have any empty space. Even if I zoom in, you see right here, there's no empty space, we have walls. So we don't have any fair value gap here. Now, the imbalance, it's actually really similar to a fair value gap. However, now some people might argue, some people might say that this concept for them it's not true, but according to my strategy, there is a slight difference between an imbalance and a fair value gap. If you want to identify a valid imbalance, it's not between 3 consecutive candles. The color of the candle doesn't matter, and basically the amount of candles doesn't matter. So, for example, if this is right here a valid fair value gap, so if we take this candle, this candle, and this candle, on the candle number 2, you see there is no price action, so it's a valid fair value gap. This right here for me would be a valid imbalance. Why? It's because we still don't have anything right here. Everything can still pass through it, even if it's not 3 consecutive candles and it's just this candle or like this wick or this wick or this wick, we still have an empty space that price can pass through it, you see, inside of this candle body. So this is a valid imbalance, this is a valid imbalance, this is a valid imbalance. Same thing, for example, right here. We had a fair value gap right here, right, on this candle at that specific point of time. Then the fair value gap starts to get filled, so it starts to get mitigated basically, but we still do have an imbalance right here because we still can throw a ball and there's no walls. If it does something like this instead, now we have a wall, right? So there's no longer any imbalance there. So now that we know how to identify a valid imbalance and a valid fair value gap, we can as well now identify our valid POIs, so points of interest. Okay, so how to identify a valid point of interest? You have to look for 4 things, okay? The first thing is if it's the right color. So if we're in a bearish market, so in a downtrend, you will need to have your POIs of the opposite color candles. So in this case, the POI needs to be blue for me. So it's a bullish candle. So right here, my POI color, if it's a bearish market structure, my POIs needs to be bullish candles. If it's the opposite, so if we are in a bullish market structure, my POIs needs to be bearish candles. This is the first things first, okay? So for example, right here, we are in a bullish market structure. This is the opposite color candle. This is my POI, okay? Same thing, for example, right here, opposite color candle. This is my POI, okay? So if, for example, I do this, that's wrong because that's not the opposite color candle in the bearish market structure. This is a bearish candle in a bearish market structure. So that's, according to my rules, it's not valid, okay? Now, after you identified the color, you need to see if the POI is connected to an imbalance or a fair value gap. So for example, right here, this blue candle, it's connected to this fair value gap, right? So this POI exactly right here is connected to the fair value gap. So it's a valid POI. Same thing is, for example, this one right here, this blue candle is as well connected to right here a imbalance, right? So it's as well a valid POI, right? Same thing, if I go here on top, there's this blue candle and it's as well connected to right here a little imbalance, right? So this is as well a valid POI. Now, as you can see right here, this is the first things first. So if it's connected to a valid POI, not POI, but a valid fair value gap or imbalance, and it's the opposite color candle, then you need to see if the POI is still clean and unmitigated. So this means that price never came back and tapped into the POI. So as you can see right here, this POI is new. There's no price action inside of it, so the POI is valid. If, for example, right here we would have had a wick that are pushing to the upside like this, now the POI is mitigated. So after this POI mitigation, the POI for a future tap would be no longer valid. So this is how you see if the POI is still mitigated or not, okay? As well, okay, the last thing that you need to look for the POIs is to see if it's inside the Fibonacci discount or premium. So if you're looking for some sells, the POI needs to be above the 0.5, so it needs to be in premium. And if you're looking for buys, it needs to be below the 0.5, so it needs to be in discount. So as you can see right here, for example, this needs to be below the 0.5 as you're looking for some buys. And for example, this needs to be above the 0.5 as you're looking for some sells. Okay. Now, a little trick that I can give you as well for POIs, that is something that I use in my strategy, is that a POI can be as well up to 3 consecutive same color candles. So as you can see right here, this is one candle, right? But I can as well include another one. So I can include as well this blue one right here, because it's the same color and they're consecutive. So my POI can actually grow bigger right here. I cannot include another candle right here because now it's no longer the right color. Now this is candle white, right? But I need blue ones. So I cannot include another one. I just need to keep it right here. Same thing right here, you know. Technically, I have this POI that is valid. But in this situation, if I include another one, now this makes the POI invalid. And the answer why, it's because now it's no longer connected to any fair value gap or imbalance. So that's why in this case it's no longer valid. However, right here you see it's still valid. So and it can be up to 3. So for example, if you have 3 consecutive same color candles, so if I go back for example in time right here, we have for example candle number 1, valid. I can include another one, still valid, and I can include another one, and right here it would still be a valid POI. And it's always better to include multiple candles inside the POI because sometimes price just comes here and then leaves. So if you just selected the most extreme POI, you might miss the trade. So let's see right here what happens. So as you can see, this is exactly what happened. Price tapped into this 3 candlestick POI and afterwards left. So if you just identified the extreme one, you might have missed the trade. So that's it for POIs. Now, as we know all of those concepts, so we already know the breakup structures, the fair value gaps, the POIs, the Fibonacci retracements. Now we're left with liquidity and inducement. So if you're talking about the liquidity and end of the inducement, you need to understand that liquidity is basically situated at each highs and lows. So as you can see right here, if we take this price action, we're gonna have high, low, high, low, high, low. We have multiple highs and lows, right? So at all of those points, we have some liquidity that was situated there at some point of time. Now, there will be liquidity sweeps. So every single time that a high or a low went through, or for example swept it with a wick or a body closure, the liquidity got taken and there's no more liquidity. So what do I mean? Right here we had this low, right? But then later on price went down and we broke to the low. So as you can see right here, if I take this low and I extend the line, we went past through this low. So the liquidity that was situated right here is no longer here. However, on the top right here, if I extend the line, you see that price never came back to that level. So there is still remaining liquidity on top right here. Same thing in the bottom. We had this little low, but price again went down and swept the low. So there's no more liquidity. And here, same thing for the top. Price came back up swept the high. So as you can see, price reached the same level twice. So no more liquidity here. We can do exactly the same thing for every other high and low. Here we broke down, no more liquidity. Here we broke to the upside, no more liquidity. Broke to the downside, no more liquidity. The upside, no more, no more, no more, no more, no more. Here we can see, so we had liquidity here, and as you can see, we swept it. So we basically went higher than this point. So no more liquidity here. But this high, same thing. We actually never came back to that level. So there is still liquidity here. Everything in the middle right here, there's no more liquidity as everything got swept. And right here, same thing. So we had this low, but we swept to this low. We came back to that level. So no more liquidity here. Here, however, we never came back to that level, as you can see. So there is remaining liquidity here. And here, same thing. We went to the downside. We swept the liquidity. So no more liquidity here. So after all of that, we can see that the remaining liquidity available is at this high, and at this high. Everything else got already swept, and this new low is getting created at the moment. So this is where your resting liquidity is. So this means that at a certain point of time, price is always chasing liquidity. So this means that if, for example, price moves forward, we'll have a lot of chances that price comes back right here, sweep this liquidity before pushing down. So we can actually use this concept to our advantage. We can, for example, identify a valid POI right here, right? And then when price will come back and sweep the liquidity and mitigate the POI, we can look for a sell, because first of all, when the liquidity is swept, there is a momentum that will bring us some value for the sell, and we as well tap into the POI. So this will give us as well an extra confidence that it will continue to push down. So this is how you can use the liquidity. Now I talked as well about the inducement. Inducement is basically where there is resting liquidity, so available liquidity close to a POI. So for example, this would be some inducement, as this is some liquidity that is situated close to a POI. So this is some inducement. So basically it's the same thing as resting liquidity, but close to a POI. Why does it called inducement? It's because it's inducing you to enter a sell before the liquidity is swept. So if, for example, right here we will have a zone, okay, and price people would like to enter right here, but there is liquidity on top, they're actually inducing people to enter at a lower point, and then they're gonna sweep them all out, and then it will push down. So it's inducing you to enter at a wrong spot. Okay, so now we have all our concepts together, right? We have all the basic concepts that we need for our SMC trading. Now we can put them all together to create the ultimate strategy. So again, you need to master each one of those concepts individually first, and then you can combine them together to create a really good and powerful strategy. So I'm gonna make more videos and more breakdowns about my strategy on the YouTube channel, but for now I'm gonna explain it how I personally combine those concepts in the most simple way, and we're gonna do a trade example. So first things first, I use multi-time frame analysis for my strategy. So this means that I'm gonna be looking on multiple different time frames to find my entry points. I'm gonna first of all start by looking at the 4-hour time frame. So first things first, I'm gonna identify my 4-hour trading range. So for example, again, like we saw, first of all, we identify our break of structure, and afterwards we identify our trading range from this low to this high. When I'm gonna be identifying my 4-hour trading range, afterwards I'm gonna be identifying my POIs. So again, first things first, set up my Fibonacci to see where is, in this case, my discount, so I can identify my POIs at the best cheap price possible. So for example, let's imagine right here I have a POI. So perfect. Now I have a POI exactly right here, so I'm gonna be waiting for a POI mitigation, so price come back into the POI, and I'm gonna be waiting for a confirmation. So as we know that this is the 4-hour time frame, Then I'm gonna be looking on the 15-minute time frame exactly right here, and I'm gonna be waiting for a 15-minute break of structure. So, for example, right here, I will be waiting for my break of structure on the 15-minute right here. When the 15-minute break of structure will happen, I'm gonna again repeat what I did on the higher time frame, but now on the lower time frame. So as you can see, I just got my break of structure. So this creates me my new 15-minute range from this low to this high. So I'm gonna be doing what? Identifying my valid POI in this new 15-minute range. So same thing, I'm gonna take my Fibonacci. Now I'm gonna have a smaller range right here. And I'm gonna identify again my valid POI on a lower time frame. So now, as this is a 15-minute range, I will be identifying my POIs on the 15-minute until the 1 minute. So I just see on which time frame I have the best POI, so the most extreme one, so the lowest POI possible. And then I'm gonna place my limits, so my order limit exactly right here, with my stop loss covering the low of the whole 15-minute range. I'm gonna target 103 risk-reward ratio for my take profit 1, and for my take profit final, I'm gonna be targeting the hourly high or low. So this is how my entry will be looking like. And that's pretty much it. So let's go and let's see it on a higher time frame on a real chart. And last thing is that when we are in the first step, so when we are in this step exactly right here, this POIs can be on the 4 hour, or it can as well be on the 1 hour. So even if this is a 4 hour range, I'm identifying my POIs on the 4 hour and on the 1 hour. And if we have multiple POIs, as you can see right here, I'm just gonna be waiting on which one of those creates a 15-minute break of structure first. So let's do a little trade breakdown for this amazing strategy exactly right here. So let me go back in time. Okay, perfect. First things first, we're gonna find a trade that happened, so it's gonna be easy for you to understand. So let's go on Euro GPY exactly right here. So first things first, you need to identify your current trading range. How to do so is by identifying your last break of structure. So as you can see right here, your last break of structure is this high, right? We broke through this high and we have now the range from the low to the high, right? Next step is to identify your Fibonacci. So you're gonna take it from the bottom to the top. That's it. Next step is to identify your valid POI. In this case, we have this POI, so the opposite color candle connected to a fair value gap. But remember, we have the opportunity to include up to 3 consecutive same color candles inside our POI. So in this case, I can include these 3 ones, right? And it's still valid as it's still connected to this little imbalance from this wick to this wick. So it's still a valid POI. So that's it. I identified my valid POI on the 4 hour. I can as well, in case, go on the 1 hour to see if there is anything else interesting. In this case, we do have this 1 hour POI that is valid as well according to my rules. You see connected to a little fair value gap right here. So we have 2 POIs. Now we need to wait for the POIs mitigation and wait for a 15-minute break of structure confirmation. So let's wait. So right here, first of all, we tapped into this 1 hour POI, but we basically destroyed it, right? We completely went through it. So this POI is ciao bye. But now we are in this 4 hour POI. So let's go on the 15-minute to see if we have any 15-minute break of structure. So in this case, the high we needed to break to confirm our break of structure was exactly this little high right here, okay? So this was the high we needed to break for our break of structure. So now we're just gonna be identifying our most extreme POI in this new range. So I take my Fibonacci and I'm gonna be identifying my most extreme POI on the 15-minute first, but there is nothing here. So I can go on the 5 minutes. On the 5 minute, there is still nothing according to my rules for a valid POI, so I can go on the 1 minute. When I'm gonna go on the 1 minute, you will spot right here in the bottom this extreme 1 minute POI right here connected to this little imbalance right here. So this is a valid POI, right? So what you're gonna do, like I said earlier in the little example, you're gonna place your limit exactly right here, stop loss below the low, covering the entire 15-minute low. So you go back on the 15-minute time frame, you're covering the low, and you're gonna as well add a little bit of pips right here in case of price sometimes wants to come back close to the POI without tapping it in. So just added a little bit of pips right here. Take profit 103 risk reward ratio, and take profit final will be your hourly high. So in this case, there's no really good highs to target. So you can target, for example, this high or even this high, but of course this high is a huge risk reward ratio and you don't want to be that greedy. So I would just be recommended to target a closer pullback. So for example, like this. So let's play this price action and let's see what happens next. So you see price mitigate exactly right here, this extreme POI, before straight away shooting up and reach our final take profit. So that's it. And this formula, you will be copy pasting this exact formula on every single market, every single time, exactly the same way. You don't need anything else. You don't need to overcomplicate even more. That's it. You don't need more than that. And as you can see, higher time frame analysis, mitigation, intermediate time frame confirmation, and lower time frame entry. It's a limit. You set it up there and you walk away. You're not doing anything else and you're waiting for the trade to play out. So that's it, guys. This is the basic of my strategy. Of course, I'm gonna be making more videos because I went kind of fast over all the concepts you need to understand my strategy right now. But in the future, I'm gonna be making individual videos to go more in depth over every single one of the individual concepts. That way you will have more practice if you want to learn my strategy. If not, you see, SMC doesn't need to be complicated. You just have a formula that works, a mechanical edge that works, and if we copy paste this exact formula every single time over all different markets, you will have profitable trades. Of course, not every single trade will win. For example, my strategy have a 50% win rate, but as you can target really good risk reward ratio, that still makes this strategy really powerful. So if you have any questions about my strategy, don't hesitate to write them down in the comments, and as well subscribe to your YouTube channel because I'm gonna be making a lot of more informative videos about my trading strategy, as well with more breakdowns in the future. And of course, I'm gonna be answering as well your questions when I see some. So guys, if you enjoyed this video and if you learned more things, don't hesitate to tell me down in the comments, as well as like the video, subscribe to the channel, and then see you soon.